Let's keep talking bonds and bring in Mel Siu, Portfolio Manager, Asia Credit at Mizunik and Company, joining us live up in our Hong Kong studios. Mel, great to see you and a pleasure having you on the show. Listen, I know you're an Asia Credit guy, but I want to start with the biggest, baddest, deepest, most liquid bond market of them all, and that is the U.S. And I want to show you a comparison chart. Let's bring that up so viewers can follow along, and I'm sure Mel can see it as well. You know, the price action overnight, what happened in equities, with yields, with oil, etc. A lot of folks are saying, well, there you go. Look, it's the taco trade yet again. Taco is back on the menu, right? And this is a good sign of it, because with the bond market, you know, and let's go back to Liberation Day, 2025. Soon after that announcement, April the 9th, we had the 10 nearly at 440. And then the president goes and says, all right, I tell you what, I'm going to do a 90-day pause on tariffs. Today, 2026, there's March 20th on the right-hand side. The 10 almost hit 440. And what do you know? Overnight, we've got the president saying, I'm talking to Iran. We had great talks, constructive talks, and I'm going to set a 5-day pause on attacks on Iran. And let's try and keep going with the conversation and try and put an end to the war. Coincidence?
So markets have been, I think, expecting a relatively short conflict in Iran. That has been the messaging from the White House pretty consistently, 3, 4, 5 weeks. And I think the chart you've shown is very instructive, because we know if that was to happen, the reaction would be as sharp as we saw after last year's Liberation Day and subsequent rollback. And then I think if you look at individual markets, what has sold off, the rates market has clearly been the one market that has sold off. But if you drill down into credit markets and look at credit spread movements, they've been relatively muted. And I think that speaks to the potential for a sharp rebound and reversal. Yesterday also, just on a Truth Social message, you saw a very positive reaction in the oil price, in stock markets, and also in the rates market, as shown in the chart you pulled up. So that's what's in the back of everyone's minds. I think that you're going to have some sort of reversal, and then markets will bounce back very quickly.
Yeah, so, you know, I think you probably agree, and Treasury Secretary Scott Bessent has said this a number of times, that it's the bond market that ends up being sort of the disciplinarian here. And would you agree that 5% is the line in the sand for the 10-year?
That seems to be. The market is focusing on inflation. I think that's rightly the near-term impact. 5%, if you break that down, inflation expectations are about 2.5%, and the US economy is growing at 2.5%. So 5% feels like where the 30-year should have some resistance, we feel. And if you look historically over the past couple of years, that's kind of been the high water mark. So that's pretty consistent with our outlook for the US economy and the fact that inflation expectations are still being kept in check.
Mel, I'm not sure whether you're Asia Credit or that means AXJ, Asia X Japan, but you know the Japanese equivalent, their 10, we're at about 230 basis points within just a couple of bips of a 52-week high. How significant is that?
Sorry, could you just repeat that?
Yeah, I was saying the Japanese corollary, the yield on the Japanese 10-year note is at about 230, all right, which is just a couple of bips away from a 52-week cycle high for that yield. Is that significant for you?
Yes, so what we've seen is long-term rates globally become correlated. In Japan, you've got the Bank of Japan wanting to normalize policy and looking to raise rates. So that's what's been driving a pretty sharp steepening over the past year and a half in the Japanese yield curve. So we expect that to keep continuing, and you've got these what everyone thinks will be these one-off shocks to inflation that are coming on top of everything that we've been experiencing over the past couple of years. So it's no surprise that also. But you also look at the euro curve and the sterling curve. There have been, definitely increases in yield curves globally.
Yeah, so this is something we were talking to an earlier guest about as well. That going forward, the curve is going to steepen, and long rates are going to go up because of fiscal pressures and deficits increasing, etc. Where is this going to be most apparent in Asia, in Asian credit?
So what we've seen recently is, the front end curves have increased significantly as inflation has priced in. So we think that there's really strong value in a short dated investment grade credit. That's something that, with yields being very high, and we don't think central banks will be cutting anytime soon. They're on hold. The Fed has signaled it's on pause. You look in Asian economies, the inflation outlook is pretty contained. It looks pretty much in check. So that's where we think that there is some opportunities. It's also a safer part of the credit spectrum in investment grade credit versus high yield credit. The economies are doing very, very well. If you think of the headwinds that we saw last year from tariffs, a lot of economies actually upgraded their growth outlooks as the fears over tariff and trade impacts turned out not to be as strong as everyone had feared. So we're actually in a pretty good place, I would say, in Asia in terms of the economies, the inflation outlook, the ability of governments to use fiscal stimulus to offset some of the headwinds that we're seeing. What's key clearly is, and I think it's now focusing minds everywhere globally, is trying to unblock the choke point that we see in the Straits of Hormuz.
Indeed, that's something we're going to be watching in the days ahead. Listen, Mel, got to go. Great to talk to you. Appreciate the time. Great value. You keep safe, and we'll do it again very soon. I hope. Mel, see you there. Portfolio Manager, Asia Credit at Mizunik and Company, joining us live up in our Hong Kong